What's up, Effortless investors, and welcome back to the channel where we make investing simple and stress-free. If you're wondering what the best investment is for 2025, you're in the right place. Today, we're breaking down the investment matrix, a super easy way to compare different investment options based on their learning curve, income potential, growth potential, tax benefits, risk level, and starting capital. We're going to be going through all manner of investments, from stocks and ETFs, real estate and collectibles, and yes, even crypto. Sorry, I should probably be more enthusiastic about that last one. Let's try that again. Even crypto. No, that felt forced. Enough with the delay. Let's get into it. Alright then, let's start with the topic that most will think of when you say investing, and that's individual stocks. These are shares in a publicly limited company that you will buy through a broker, the most well-known of which are companies like Google, Facebook, Apple, and Amazon. You'll need to learn about companies you're investing in and make sure they align with your investment goals. You'll need to monitor market trends to assess whether or not that company is still a viable investment, and keep up to date with your chosen stock's financial statements to understand how they're performing. Now, it's not rocket science, but can take time, which is why I've given the learning curve a moderate rating. Now, the income potential I'd say is medium. Some stocks do pay dividends. How frequent they pay out and the percentage of the dividend will differ depending on the company. Not all do pay out a dividend. So it's important to do your own research. An example of some popular dividend stocks in the UK would be British American Tobacco, Legal & General, Phoenix, and Unilever. Now, I'm not suggesting you invest in these companies. As always, please do your own research. Most of your gains will likely come from price appreciation though, which leads us nicely to the growth potential, which I have set as high. Depending on the stocks you invest in, or if you're an early investor in a company, you have a chance to grow your investment to a very healthy return. Now, obviously, no gains are guaranteed, but if you do your research or just happen to get lucky, there is potential for high gains with stocks. Now, for tax benefits, the short answer is yes. Some tax advantage accounts, like a stocks and shares ISA or a Roth IRA if you're in the US, let you invest tax-free or tax-deferred at least. This essentially means that dividend income and your growth returns are exempt from capital gains and income tax. Now, despite having a high growth and decent income potential, stocks also come with a medium to high risk level. Markets can be volatile, and there is no guarantee that the companies you're invested in will continue to grow or stand the test of time. It's why you'll hear the term diversification a lot when you start looking at investing in the stock market. This essentially means not investing all your money into one company or one sector even. A well-diversified portfolio can help manage the risk. But it's important to understand that there is always risk there, no matter how diversified your portfolio is. Now, when it comes to the starting capital required to invest in stocks, I'd say it's pretty low. The benefit of modern technology, or fintech as it's known in investment circles, is that it's never been easier to start investing. Thanks to apps like Trading 212 and eToro, you can now trade in fractional shares, meaning you can start with as little as £1. Sorry if that sounded like I was just regurgitating an advert. Let's move on. So that's stocks. Next, we're going to talk about exchange traded funds, or ETFs for short, which are basically baskets of stocks in one handy package. You can have ETFs that track particular sectors, geographic locations, or even market indexes. One of the most popular ETFs are ones that track the S&P 500 index, which consists of the top 500 publicly listed companies in the US. The average annual growth for this fund is around 10%, making them a great and popular investment for beginners and experts alike. Now, I'd say the learning curve is low, simply because you don't have to put in the same amount of research as you would for stocks. With ETFs, you're not going to have to research each individual company. You're going to be analysing what the ETFs track, whether that's a particular sector or index. As there are some really useful tools online like justetf.com, it's quite easy to get a breakdown of an ETF and check its past performance, dividend output, fees, and just as importantly, its holdings. ETFs are beginner friendly since they give you diversification without having to pick an individual stock. Now, I'd say the income potential for an ETF is low. Not all ETFs pay a dividend, and you can get some that will accumulate any dividends they get paid from their holdings, which means they will just reinvest those dividends automatically. There are some dividend-specific ETFs which will pay a dividend quarterly. The dividend for those usually sits around 3 to 3.5%. An example of some dividend ETFs would be VHYL or JGGI. As with stocks, it's important to do your own research and establish whether or not dividend investing is what fits your goal. For their growth potential, I would say it's medium to high, maybe closer to medium. Unlike stocks where you can buy a penny stock and it could go up by thousands of percent, in a short space of time. ETFs are more for long-term investing goals and are likely to provide you with steady growth over time. Obviously, you get some ETFs that are tailored more towards aggressive growth. A fund like EQQQ, which tracks the top 100 companies in the Nasdaq index, is one such fund. It's grown by 24% in the last year to date, although most ETFs are looking for gains around 8 to 12%. But as always, no gains are guaranteed. In regards to the tax benefit, it's the same as stocks. Provided you're purchasing ETFs through a tax-advantaged account, like a stocks and shares ISA, you'll be exempt from capital gains tax and income tax. As for the risk level, they tend to be lower risk than stocks as they are more diverse, due to the fact that they have a collection of holdings as opposed to just the one. Again, similar to stocks in the fact that modern technology now allows us to buy fractional shares for as little as £1, so we'll be marking the starting capital as low. Now moving on to the next investment type, we've got a real estate investment trust, or a REIT for short, which is a company whose shares you can buy that owns, manages, or finances income-producing properties. Similarly to how you would buy a stock or an ETF, a REIT can be bought through a broker or through a modern investment platform like Trading 212. Some of the more popular REITs on Trading 212 would be Realty Income, AGNC, and Gladstone Commercial. A REIT is an interesting way of investing in real estate without having to buy a property. There's not a lot to know about REITs other than what the company you're buying shares in will invest in, whether they invested in residential, commercial, or both. Now, it is easier than buying real estate, but still requires some research, so we'll mark it as a low to moderate learning curve. Now, in regards to their income potential, REITs are legally required to pay out 90% of their income as dividends. So this makes them attractive from an income perspective. So we'll mark them as a high for income potential. On the flip side of that, there is not a great deal of growth potential unless you're reinvesting the income you receive back into more shares. I'm not saying they won't grow at all, it's just not the primary focus of the investment. We'll mark them as low from a growth perspective though. In regards to tax benefits, in short, no. Unless you're investing in the REIT through a tax advantage account like a stocks and shares ISA, otherwise the dividend income will be taxed as ordinary income. From a risk perspective, house markets ebb and flow but largely grow in the long term. Aside from a housing market crash, it's not that volatile. The focus of the REIT will also have an impact on its growth, whether its focus is residential or commercial. On the whole, I'd mark it down as medium risk level. Now, much like stocks and ETFs, you can buy REIT shares through a stocks and shares ISA on a platform like Trading 212, where you can purchase fractional shares, so for as little as £1 you could buy into a REIT. So we can mark REITs down as low starting capital. That moves us nicely onto traditional real estate. If you're put off by the complexity, or if you feel like you lack control in the stock market, perhaps real estate investment is for you. The housing market tends to not fluctuate as much as the stock market, so it may seem a more enticing investment to some. So I guess the question is, do you need to know a lot to start investing in real estate? I would argue yes. There is a lot to learn, specifically with regards to loans or mortgages, how and what to do with any equity you have on your property. You'll also have to research maintenance requirements, as they will differ between residential and commercial properties, particularly here in the UK. In addition to this, you also have your tenants' rights to consider, and so for that reason, we'll mark the learning curve as high. For their income potential, it's no surprise that we'll mark it as high. I mean, both residential and commercial properties can generate passive income from rent every month. As for the growth potential, the latest land registry stats show that house prices in the UK have risen by 95% in the last 20 years. So if you're young and your parents are telling you need to start saving for a house, they may be right. So we'll mark growth as medium to high. Now, with regard to tax benefit, you're only really going to benefit as a first-time buyer in the UK. As a first-time buyer, you'll be exempt from stamp duty land tax. Other than that, there is no real tax benefit to owning a house. So we'll give it a yes, but with an asterisk. Now, there are a couple of risks to consider with real estate. Firstly, property values do fluctuate. Although historically house prices have gone up, there is no guarantee that yours will. You also have to account for market trends, specifically when it's a buyer's market and when it's a seller's market. Ideally, you would want a buyer's market, which usually means the house market is saturated with properties, meaning sellers have to bring their prices down to make them seem more attractive. You also don't always know the type of tenant you're getting in your property. If they're good, it's great. But if they're bad tenants, it can be a headache. That being said, we'll mark the risk level down as a medium. Now, the main issue you're likely to come up against is the starting capital. Property isn't cheap, even in more impoverished areas. The average UK house price is £302,000. £1,000, which means an average 10% deposit for a mortgage will be £32,000. Now for most, that's a significant starting investment, so we'll have to mark capital required as high. And that about wraps up the real estate portion of the video and brings us to crypto, the wild west of investing. Now I know I sound pessimistic about crypto, and that's because I am. But for the next few minutes, I'll try to remain impartial. So the learning curve, in short, is high. You'll need to spend time researching and understanding the blockchain in relation to crypto, the security protocols surrounding crypto, and also the differences in the more commercially viable coins like Bitcoin and the utterly pointless coins like every single meme coin. Now there are some coins that offer staking rewards which effectively work like a dividend payment from a stock. There are, however, not so many of them, so I wouldn't recommend that as a strategy for improving growth. So we'll set the income potential as low. Moving on to the growth potential, on a positive note, in all honesty, is high, if not very high. Crypto coins like Bitcoin and Ethereum have seen massive gains, but they're volatile. And if you invest in meme coins, which I'm not suggesting you should, they have a lower starting value and the potential to rise dramatically, but meme coins tend to be even more volatile. For tax benefits, I'll keep it short and sweet. The answer is no. Crypto coins are taxed as capital gains and sometimes as income. And in regards to risk level, prices swing like crazy and the regulations are unpredictable. Crypto as yet is still not commercially viable as an asset, so any investment in it seems speculative at best for now, so we'll give that a very high risk level. On another positive note, the starting capital is low, as like stocks and ETFs, you can start with a very low amount. Just be aware of the fees. Now swiftly moving on from crypto to the world of collectibles, which in essence can be nearly anything. You've got cars, art, shoes, watches, trading cards, soft toys, the list goes on and on. If you own it, chances are someone out there collects it. With that being said, I'm going to mark the learning curve as high simply because you're likely to need to understand or have some expertise in identifying the authenticity of the items, their market demand and rarity. There's a lot to know before you even get to a valuation point. As collectibles are physical items, they're not going to generate any income on their own. The only way of really generating any income from collectibles is if you rent them out. For example, if you own a classic car, you may decide to rent it out for events. Weddings are a common event to be rented out to. Outside of this type of action, you're not going to passively generate any income. So for that reason, I'm going to mark the income potential as very low rather than zero. Now, as far as growth is concerned, it's going to depend on trends. Most collectibles tend to go in and out of fashion for collectors. While there are some that stand the test of time, art and watches would be two examples, most aren't guaranteed to rise in price and stay there. There is also no guarantee what item the next generation of collector is going to value. So for that reason, we'll mark the growth as a medium. Tax benefit again is an easy one. It's a no, unfortunately. Collectibles will be classed as capital gains when they're sold. As far as risk level is concerned, as I've already mentioned, market demands are going to dictate how valuable your collectible is, and there's no real way of knowing what is going to rise in value and what isn't. You're also going to have to deal with the fake collectible market, which if you end up on the wrong side of, will completely devalue the investment you've made. So we've marked the risk level here as high. Now the starting capital is going to vary depending on what you're investing in. If you decide to invest in an item that you think could be the next big thing, then your starting capital may be low to medium. On the flip side of that, if you're looking to invest in an item that's already established as a collectible, say comics for example, you're going to need more capital to start with. I think to balance it out, we'll probably mark it as a medium for starting capital. So moving into the final two investment types, I would class them more as complementary investments. You're not likely to pump all your money into either one, so we'll start with bonds, which are a solid option for low-risk investors, or for those nearing retirement who want to remove some of the capital from the volatility of the stock market. In terms of a learning curve, it's pretty low. Government and corporate bonds are fairly straightforward, particularly here in the UK where we have NS&I bonds. They're really simple to set up. You can even set them up for your child. Now I'm going to mark the income potential as low. I'm using NS&I bonds here as an example. There is no guaranteed income or winnings. It's effectively a lottery. Now you can win substantially, but the odds of winning are 22,000 to 1, and the payout could be as little as £50. In regards to growth, it's the same as income. There's no guaranteed rate of return and no guarantee of winning. So again, we'll mark it as low. Now this will differ depending on your government or if you invest in corporate bonds, so please do your own research. some bonds will offer a low rate of return. With regards to the tax benefits, it again depends on what bonds you're invested in. Again, using NS&I for an example, the winnings are tax-free. Some other bonds may fall under income tax, so please do your research before investing. So I'll mark this down as a question mark, which doesn't look helpful at all, but we're moving on to risk level. Now, government bonds are among the safest investments, so we can safely mark that as a low level of risk. And as for the starting capital, it's pretty low. Most bonds will have a minimum buy-in between £25 to £100. NS&I, for example, is a £25 buy-in. Now on to the final investment type, which is commodities. I'm talking about gold, silver, oil, even wheat. Now, as I stated earlier, these would be more like complementary to the rest of your investment portfolio. Now, the learning curve is low. You only really need to understand supply and demand trends, but this will depend on the type of commodity you go for. The income potential is going to be zero, as they don't offer any passive income at all. There's not much growth to them either. It's likely lower than a standard savings account. Gold, however, does seem to hold its value over time. Tax benefits are zero, as they are taxed as capital gains. In regards to the risk level, the prices are going to fluctuate based on global events, which makes them difficult to predict. So we'll mark that as a medium. The starting capital is going to vary depending on whether you're buying the physical asset or if you're buying shares in a stock or ETF that tracks the asset. So we'll mark it as low as you can invest in the asset on a platform like Trading 212. And so there you have it, the investment matrix for 2025. Breathe it in. So, have a think about which investment is right for you. Remember, it's going to depend on your goals, your risk tolerance, and your starting capital. Let me know in the comments what's your favorite investment for 2025. And don't forget to like, subscribe, and turn on notifications for more effortless investing tips. See you in the next one.